You see Kathy along with Franklin. So and along, I think Phil is joining us now.
Great.
So if you would like us to begin.
Okay, why don't we begin? We have a pretty light agenda. Let's do the roll call first.
Of course. I do want to remind folks that we are live streaming and recording this meeting. Both of those have started already. Jerry Abrahams. I see that Phil is connecting to the audio right now, so we'll come right back to him. Tim Hodges. Kathy McKinnon.
Here.
I'm sorry, Tim, was that you?
Sounds like him.
Okay. Commissioner Perez. Franklin Perry.
Here.
Chelsea Ross. Sarah Sanders.
Here.
And Phil DeFranco.
Here.
Thank you. We do have quorum for the meeting.
Great. Well, happy summer, everyone. I can't believe July 4th is at our door already. My goodness. Summers go so quickly in Connecticut. We have just an agenda of reports today, and then approval of the minutes. And the first agenda item is a report on the last bond sale with Morgan Stanley, Jeff Prue, and Hazy.
Yeah, thank you. So last month, you heard from Corey describing the sale for the single family bond, and this morning we have Jeff Prue, who leads the housing group at Morgan Stanley, and he's going to talk about the multifamily transaction that we did, and against the backdrop of a sell-off and the importance of retail investors to the transaction. So Jeff, why don't you take it away?
Great, thanks, Asim, and good morning, everyone. I appreciate the time this morning, and also, as always, appreciate working with you all and senior managing your transactions. It's our pleasure, particularly when it works out great, and that's what happened with this deal, which was really, really good. Back story on the transaction, the use of proceeds were for 8 multifamily developments in the state, so 4 new construction and 4 rehab deals. Dispersed throughout the state. So we had 3 in New Haven, 1 in Meriden, 1 in Hartford, 1 in Storrs, 1 in West Hartford, and 1 in Torrington. So really nice production here, and a total deal size of $122 million, divided between long-term bonds of $57 million and the construction bonds of $65 million. Going into the pricing, there were some dynamics going on in the market. Hazim alluded to this. We were very cognizant of economic indicators, also Memorial Day as the holiday week, and supply in the market. So what we have been seeing in the course of this year is supply in munis is up, generally speaking, and up substantially with housing. So in any given week, when we have a pricing and we're looking 2 weeks out, we look to see the overall supply. And if the supply is very heavy, we talk with the financial advisor and the issuer about devising a strategy to navigate through those waters. Because what we don't want to do is get anchored up against a large amount of housing production, because what we will often see is that prices go in a direction that's not in our favor. Looking strategically and working with our underwriting desk, we talked with them about a little bit of an unconventional strategy, which would be to delay the deal by a week and go into the market during Memorial Day and Memorial Day week. And what that would mean is that, given the holiday, we would not launch at the beginning of the week. We would launch on Wednesday, and we would try to do the transaction all in one day. What we were looking to do, in short, is avoid the week prior to Memorial Day when everybody else was coming into the market. So in that week, there was about 15 billion of overall supply in the muni market, which is a very high amount of volume coming into any given week. Thinking about that, avoiding that would be a good idea. There was also 6 housing deals that were scheduled for that week in the total amount of about $1.5 billion that would be pricing. One of those deals in itself was over 400 million, and that was Pennsylvania housing. When you get a deal of that size coming into the market, oftentimes what that means is you'll have a size premium associated with the coupons on the bonds. And particularly when you have a whole bunch of other deals with that, we were concerned that the market would be focused on that whole range of deals. And our deal, while your credit is terrific, the sizes would not measure up versus those larger deals. And we wanted to really highlight the Connecticut housing credit and push that into a week where there wasn't a whole bunch of other stuff, particularly a very large deal from Pennsylvania. What we suggested to Kane Mitter and Hazim and the finance team was, let's look at Memorial Day week. The supply that week in munis was muted. It was just about 5 billion, so a third of what was in the prior week. And on page 4 of the pricing book and the materials, there were a couple of deals that were in the market, but really our deal was the deal of the week, which is always where you want to be, because that means that investors are very much focused on your transaction, the credit, the coupons, all of those things. The other thing that we really wanted to position here and have our credit stand out essentially alone was to, and we're on page 4.
So Lorraine,
There we
yeah,
go.
the page before.
There you go.
Yes.
Perfect. If you go down, just scroll down slightly on this page, you can see that the other deals that were in the market were small and basically local. DC Housing, Montgomery County, and also West Virginia. This sets you up for a week where very little competition. And the focus here institutionally, but we really wanted to go after the retail market. What happens when we get good retail subscription is that we fill the maturities. So when we go to talk to the institutions about it, there's not a lot of bonds left to sell, and we can really leverage those retail orders. And that's what we were able to do here. The market, because retail investors, both in-state and nationally, love housing bonds. They like the par structure. They like the coupons because in housing, there's a slight spread associated with the housing calls in the transaction. So, and they like the credit quality. AAA, housing spreads, par bonds. Really good recipe for a great result. In the deal, we saw 55 million of direct retail orders. That's not professional. That's not managed money. That's individual families that are coming into the transaction. When you have a deal size on the long-term fixed rate of 57 million and you've got 55 million of direct retail, you're having a good day. We also had a combination of institutional and professional retail orders from 23 different accounts. That's a great number too, because this means that we really had focus in the market for almost 220 million. What that resulted in, and you can see it down at the bottom of the page, is just excellent execution versus these comps and versus comps the week prior. What we like to think about is if we're going to have good success on a transaction, we like to see retail orders coming in across the curve. That's what we ended up getting, and it allowed us to lower interest rates in the face of a super difficult market. So MMD was reacting to just volatility in the market. So the spreads on the index increased by 10 basis points, but because of the retail order subscription, we didn't have to move our rates at all. So basically one of the best executions that Connecticut Housing has gotten in some time. And you can see that on page 5. We've listed here to give an indication of how the overall performance has been on a spread basis. And you can see the dark line in the legend, it's all the way to the right. This is the long-term financing and the spreads to MMD across the yield curve. And the black line is basically at the bottom of the full range. That's saying that we got one of the best executions that Connecticut Housing has gotten in the market for a long time. I will tell you that the reason for that entirely is the overwhelming response of retail to the sale. We had over 155 million of retail orders for 120 million of bonds that we were selling, and that's even before we got into offering it to institutions. So at the end of the day, you can see some of this performance. If we go, Lorraine, to page 15, just to give a flavor of the in-state Connecticut retail orders and where they came in the state. We can scroll down. There we go. We always include this map, and the folks in Fairfield County love Connecticut housing bonds. They were in for 36 million of retail. And then you can see it was, all across the state. This type of performance, you always want to see it. Flipping to the prior page, we've also included a listing of the institutional buyers who came into the transaction. Really long list, both on straight up institutions and professional retail. So overall, Hazim, is there anything else that you think that I should focus on that haven't already covered? I talked a lot, so sorry about that.
It went in our favor. The market
I
was.
thought the last deal was the best deal.
No, it's always us, Sarah. Okay?
I was thinking the same thing, Sarah.
It's always the best deal.
Whoever's in front of us today is the best deal. Even if
Hey,
they compete with the
sorry.
big boys.
It's Jerry Abrahams. Can you guys hear me?
Yes.
Yeah,
sir.
we can hear you now. Yep.
Hey, can you guys hear me?
Breaking
I
up a little.
apologize. The power is out here in Western Connecticut,
You sound
so I
terrible.
apologize for being late. Yeah, never mind. I don't have a good. The power is out here, so it's all sketchy.
You can
Yeah,
text your
I'll be
question
quiet.
or type your question.
Yeah, you can put it in the chat, Jerry.
I had a question about this. They were
Okay.
all offered as sustainability bonds, right? Were you able to document any bona fide ESG investors that came in? These look like
Yeah, and Sarah, on that, Invesco and Rockefeller are ESG oriented issuers. So yes,
Yep.
and the nature of the developments too, comment on that. We're always very focused on trends in the ESG market, and there continues to be more focus on climate change and resiliency around that. So what Connecticut Housing is doing particularly on its new construction developments with a higher range of energy efficiency is always a good thing. So, and I think that will be a focus that will continue in the market.
Great. Jerry, I think has a question. What was the spread to MMD versus our last deal? I think that was that graph above. Because
Yeah.
the last deal was went in on a week that was low volume.
And that's what we did here too, Sarah. And if we just flip back to page 5, Lorraine.
It was a graph that had all the recent deals, I thought. There we go.
Exactly. So in this, it's in 2 pieces. So the chart on the left-hand side of the page is the long-term fixed rate deal. So the bonds that went out 40 years, serials terms out to 40. And then the construction bond is shown in the chart on the right. And so black line here is at the bottom. This says that your spreads to MMD are the tightest across the curve that Connecticut Housing has seen in some time. We didn't go further back than 2023 transactions. So this is all of the deals in 2023 and 2024 year to date. Part of the reason for the excellent performance here, very much driven by retail, and MMD, Jerry, adjusted by 10 basis points, not in your favor, because of overwhelming response to retail and practically every maturity. We were in a position of total strength where we didn't have to respond to the market and raise our rates to match MMD. Oftentimes, when you have a sale that goes into the market, you will match MMD adjustments. Our lead underwriter felt that our retail order book says it all. We don't have to do this. And the
Right.
institutions then basically agreed with that on the strength of the overall order book. The same thing happened on the put bond. There has been some softness in the fixed rate soft put bond market, and there aren't a lot of this style of bonds that are offered in the marketplace. This performance versus the transaction from last year with a spread to MMD of plus 100, when we got done at just over plus 60, really terrific result here.
But I think, so you're the black line, and then the last deal that we thought was so strong was the gray line, I believe.
That's exactly right.
Okay.
So we were happy, and we were happy that people in Connecticut wanted to buy into their housing agency. So
Right.
overall, all terrific.
Yeah, I kind of have a question. It seems like CHFA comes to market every 2 or 3 months. Is there any thought to doing bigger issues less frequently? I know you have a few underwriters you like to rotate with, but how
Yeah.
often are you coming, Hazim? It almost seems like every month, but every
Yeah, it's general, you know, what we've been doing is between 3 to 4 months for a single family, in part because we're using the sale as a hedge against our pipeline.
right.
So yeah, you know, like say that for this particular deal, you can't predict what was going to happen. We could have like sold a bigger deal, but then, you know, within the next 3 months, the market actually might even be better than what we're seeing today. And that's always been part of the dynamics when it comes to managing interest rate.
I mean, in some ways, we're taking interest rate risk in multifamily aggressively because we close on those initial closings for the multifamily developments before we sell the bonds. So we're actually
Right.
helping the industry by locking in their, before we've even realized our
Right,
lending.
right.
Yeah, so,
Yeah.
Is there any, is there, oh, sorry, good question. Is there any hedging on that?
yeah, well, for which one? Multifamily or single family?
Multifamily?
No, we're using our own balance sheet to hedge.
But on single,
Yeah, on single family, yeah, we were just that we're using the sale in itself as one of the hedges.
But your single family and multi, there's either one, there's not a hedge. You're just using your balance sheet as the hedge.
Correct. I mean, multifamily is a bit more of a true balance sheet hedge just because
Of the size.
of the side, the deal already closed. Single family, because we reset our rate on a daily basis. So as interest rate rises, we are also increasing our mortgage rate. So that in itself is hedging against when we sell the bonds.
Got it.
Let's see. Okay, Jerry had more, for Jerry, I'm translating for Jerry. Let's see. He says, thanks, nicely done. Note the difference between best spread versus worst, not significant. That's true. These are all very tight. That's true. Any
Yeah.
other questions for?
overall, I just would have to say from the perspective of an underwriter in the marketplace, Connecticut's bonds trade really well. And your AAA credit rating is incredibly well received in the marketplace. And your credit is also viewed as one with super great management and a robust program. So you benefit by retail in the state. It comes in pockets and waves. We hit a really great wave here, so that was good. But overall, program's really strong. And coming into the market, Sarah, just to respond to the question about frequent issuance. One of the things that the market really likes and responds to, and we've heard this from a number of institutions, also from some of the big FAs, is that your schedule of coming into the market is very clear. And so they've asked questions about other issuers saying, Connecticut Housing has a real routine schedule of coming into the marketplace. We love that because we can think about it as
Right, get
opposed
ready.
to those that will pop up every now and then. And when you get into larger size, you also start to experience what I was referring to when I was talking about Pennsylvania as size premium. And in crowded markets, that size premium can be very expensive.
Any other questions on this report? Looks like an excellent sale. Let's go on to financial reports with Allison Murphy.
Good morning. Before you are the financial reports reflecting the results through the end of May. On the revenue side, mortgage loan and investment interest revenue are coming in 8.5 million above budget and 13.6 million higher than last year. The year-over-year revenue variances continue to be driven by the increase in interest rates on the authority's investments. On the expense side, bond interest expense is 1.9 million above budget through May and 11.3 million higher than last year. The authority's outstanding bonds as of May 31st are 392 million higher than the same time last year. Plus, we are seeing higher interest costs on our variable rate bonds. Servicer fees are 4.2 million above budget through May and 3.8 million higher than last year. The increase in single-family production is behind this variance. Administrative expenses are coming in 2.8 million below budget and 362,000 higher than last year. When you exclude salaries and benefits of 12.8 million, the current year expenses are 145,000 lower than last year. And lastly, the change in net position is above target by 7.4 million. Are there any questions?
You guys are always above target by millions of dollars on net position. It's great to see.
It is great to see.
Now servicer fees being so much above expectation, is that just volume related?
It is.
So it's kind of good news at the same time.
Mm-hmm. It's a side effect of volume for sure.
Any other questions for Allison? Seeing none, we'll go to the production and delinquency report. John Chilson.
Good morning. For the month of May, the authority purchased 232 loans totaling $60 million, 15% in loan count and 33% more in dollar value over May of 2023. That's 96% of May's production was securitized, which is 222 loans totaling $57.7 million. And then the remaining 10 loans totaling $2.5 million were whole loans. The average loan size was $260,000. The month-end mortgage-backed security balance for May was just under $3 billion, which was $45 million increase over April. In April, the whole loan portfolio continued its gradual decline, declining by 49 loans or $6.5 million, ending with a portfolio balance of $1.1 billion. The loan delinquency rate schedule we changed up just a little bit, and we slid the comparison of the state, New England, and national delinquency rates up to be parallel with the whole loan delinquency. So it makes more of a visual comparison. And when you look at that, you can see that our whole loan portfolio delinquency rate was 4.12%, which is 20 basis points higher than the national average. And then what we like to do is look at that as an overall risk exposure to our total delinquency for the single family portfolio, which includes the $3 billion of mortgage-backed securities. And that blends the overall delinquency rate down to 1.13%. And the carry balance for loans in foreclosure year over year decreased $4.4 million to $12 million, while the number of loans in foreclosure declined by 30. For the month of May, the authority also funded 88 down payment assistance loans totaling $937,000, average loan size $10,650, and then also 238 time down forgivable loans totaling $7.5 million with an average loan size of $31,700. For our multifamily portfolio, we had 10 new loan closings, increasing the overall portfolio by a net of 8 to 594 multifamily loans with a portfolio balance $1.4 billion. There were 7 permanent loan delinquency rates. Seven permanent loan delinquencies with an overall delinquency rate for the portfolio of less than 0.5%.
Yeah.
Any questions?
So our first-time home buyers are able to win the bids on houses, it looks like. And what I've noticed is prices are still very high, but there's more. I just anecdotally see so many more houses coming on the market than in the past, but that's just kind of a comment. But someone had a question?
Yeah, Sarah, it's Tim Hodges. Can you guys hear me?
Yes, we can. Welcome.
Yep, great, thanks. Hey, thanks for that information, and particularly explaining the delinquency. That was helpful, because as I looked at it, I didn't have a chance to look back, and I knew that it looked different, but didn't have a chance to really do any more research. I am curious, and maybe I feel like we've done this before, but in terms of the loans that we're doing, and to Sarah's point about the fact that the people seem to be finding houses, is how often will we look at or see a map of where these loans are being actually made? I mean, is it I'm assuming it's not Fairfield County as much as it might be like New London County or Hartford, but are we looking at that periodically, or is there a way for us to look at that each month?
Yeah, we actually do. I believe that's in the mortgage meetings monthly report. So Tim, there is a package that's produced monthly that we do have that information, and I can forward that schedule to you. It's a map of Connecticut that shows where the loan productions come for that month.
That would be nice to add to our report. Yeah.
Yeah. So what you're telling me is I should probably be more studious and look at the mortgage package.
So the mortgage package is produced quarterly.
Oh, okay.
A lot of the information is repeated month over month, and so in order to make it useful and actually have something that we can talk about, we've done it quarterly. So we're happy to. It is part of the board
Right,
package.
it's part of the board package.
Oh, okay.
The most recent one.
Yeah, to answer your question, inventory is generally an issue, and I think we're seeing that inventory is still a third of what it was, before COVID. So, but yet we are we are experiencing increased production. So if you look at that as sort of, sort of a cognitive disconnect, sort of between what the news media is saying and what our experience is versus, what our production is showing. Fairfield County tends to be a harder place for CHFA, and, maybe for good reason. Prices are a lot higher. Affordable inventory is very difficult to come by, and, there's a question about whether CHFA's resources would really go as far there as it would in other places. It's something we are concerned about, we're looking at. And ultimately, if we did have a non-first-time homebuyer program, that may be an area that we could use, or a program that we could use to create, some CHFA production in parts like Fairfield County or even Litchfield County, where house prices are just, a lot higher than our average loan size would allow us to do.
That's helpful. Thank you. To Sarah's point, it would be great if maybe if we could include it in our package as well. I will try to look at the mortgage package more. But Nandini, your point is well taken. I will, almost guarantee you, if we were to kind of discuss this, we would say let's go where we can have the biggest bang, and it's not going to be in Fairfield County. But my point is that there's still, lots of people in Fairfield County who can't find housing and need it. So I'd love to talk about that more to make sure that we're, providing some opportunities there, more opportunities there if possible.
Will do.
I think we talked last meeting about how the time to own is helping drive our production, of course. And
it is. In fact, we're seeing a significantly greater percentage year over year, time period over time period, of first mortgages in areas of higher opportunity. And I say that in quotes because We define that in a certain way, but sort of equate that to areas of higher cost in the state. So we are seeing greater penetration in areas like Fairfield County with resources like time to own, because of the fact that it can buy down the purchase price as significantly as up to $50,000. So we are having an impact. In terms of significantly moving the needle, I think that's going to take more concerted effort, maybe more resources coming into play, more outreach, more marketing, and ultimately more inventory. So I think there are a number of headwinds, so to speak, when it comes to creating affordability in areas of higher cost. And so we're doing what we can, but there's certainly room to do more.
Yeah, I'm not sure it's showing up in the numbers, which tend to be a little delayed, but I really think volume is going up. I just think I see so many more houses on the market, so I'm hoping that will be helpful. Any other questions on this report? Okay, next is our.
So last thing, Sarah,
Yeah.
and I'm sorry, I don't want to dominate the conversation, but Nandini, as we talk about this more, I think about, my bank as an example, which also has down payment assistance program, but are there opportunities for us to work with other partners, particularly, if we look at, again, I'm using Fairfield County as an example, if we can't necessarily break through with our programs, are there opportunities for us to partner with other institutions, lots of families and foundations and others who are really focused in on this issue? So again, would love to talk about it more.
Absolutely. I know HDF is an organization that works and is doing great work in the Stanford area, and they've created a number of opportunities for new construction, development, and affordable home ownership through a condo and community land trust model. We do work with them. We financed their condos through our first mortgage program. Certainly open to discussing how we could work, with M&T or other lenders who are in the space.
Thank you.
Thank you.
I just wanted to comment on what Nandini said about the buying patterns with some of these programs, and that people aren't necessarily using the money to buy the lowest cost house, but rather a little more expensive house than they would have normally been able to afford in, a more expensive neighborhood. And I think that the Federal Home Loan Bank has got a big down payment program, and I think they saw the same trend. So, I think I just think it's interesting that
is there any,
it's serving that other mission, I think.
Is there any statistics of that? Because anecdotally, I don't, being a lender and the front-facing lender, I don't really see that. I see quite the opposite. I see people who, like the benefit of the time to own and the down payment assistance programs. I mean, I'm not debating you. I would love to see the statistics of that in some way, because I feel it's more like the stories we see are like, oh, I couldn't get into this house, and it's like, I mean, the average loan size, what is the average loan size right now? Is still under 300,000. I mean,
it's really difficult I think it's a difficult question to answer, because you don't really know if they're buying more house.
Right.
Yeah.
Source, or prices have gone up enough that you're seeing this differential, but because we are seeing a significant differential, up to 20% higher in loan amount and house prices. But part of that could be what, the inflationary conditions that exist right now. So, and it's a what if scenario, because, you don't know what they might have purchased 3 years ago before time to own came into existence. And so now you're trying to speculate about that. So it's a little bit difficult to answer that.
But isn't the overall average loan size still below $300,000? And I mean, what's the average sales price in Connecticut? I don't see people using this program to, like, they're not buying a $500,000 house. It's like, that's what, I guess that's my point.
Yeah, yeah,
You
yeah.
know, I see more stories of it being like, oh my God, I couldn't afford this house. And now I can because I get the $25,000 zero payment and it reduces my, I guess I see more of that than somebody saying, wow, I got $25,000 free money. I'm going to go buy, or 50,000, I'm going to go buy up. It's more, and then that's just one extent, once again, anecdotally.
Well, but I will say that compared to before time to own came into existence, we have 30% more production going to areas where traditionally we have not had a lot of production. In other words, higher cost areas.
Correct.
Usually we've been, very Hartford centric, New Haven centric, New Britain, some of those cities, urban areas. And now we're seeing, a little bit more, incrementally more production in areas that we haven't traditionally seen. And so that's giving us some hope that we're able to make this program, have it provide access to areas where traditionally first-time home buyers have been priced out. So that's kind of encouraging as a statistic. But Lisa, did you want to say something, or seemed like you were, no, okay.
Any other discussion on that? Our final item today is approval of the minutes of the Finance and Audit Committee meeting of May 30th, 2024. May I have a motion?
So moved.
So move.
Second? Do I have a second?
Second.
Oh, perfect, thank you. And all those in favor, please say aye.
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 Opposed? Abstaining? The minutes are approved. Any other matters or suggestions for future topics?
I just want to make sure the record reflects that even though I joined a couple minutes late, I was in the meeting.
Thank you, Commissioner. Very good. Well, with that, I'll have a motion to adjourn. All in favor, say aye.
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 And we'll see you at 10 o'clock. Thank you, Jerry.
Thank you.
Okay.